So I wanted to make a video focusing on market corrections. More specifically, I wanted to statistically test some common rule of thumbs I've heard going around for which stocks to buy during a market sell-off like we saw at the start of August. I performed analysis on almost 3,000 US stocks going back 30 years. And zooming in on each market sell-off during that period, I wanted to answer questions like, should you buy the stocks that have fallen the most? We will also analyze past market corrections for some much needed perspective, and we're also going to talk about some do's and don'ts during market stress. But first, what is a market correction? So a common used definition is that a stock market is in correction if it has fallen by at least 10% over a certain period. Looking at the S&P 500, for the past 20 years, we have seen in total 10 corrections. Some of these corrections were notably worse than others. The market fell more than 20%. We call these periods bear markets. Luckily, these are less common. Going back as far as 1950, more than 70% of market falls since then has not led to a bear market. And the frequencies of bear markets is quite low. For example, the bear markets we saw in 2020 was more than 10 years after the last one. On average, since 1950, it takes more than 5 years after a bear market until we see another one. And it's good to have some perspective. Even though we frequently see drawdowns in the market, looking at the returns for the full calendar year, it appears that the worst thing to do in a market fall is to panic and start selling because eventually the market rebounds. So instead of selling, one might be tempted to buy. If you got cash laying around, it might be attractive to invest in stocks that now look cheaper. Actually, the best days of the S&P 500 came after some of the worst periods of the index. And the same holds true for European stocks as well. So yes, who wouldn't want to time the rebound and achieve those great returns, right? Well, that's the issue. Timing. The time until the market starts to recover again is of course unknowable. On average, since 1950, a market correction lasts for roughly 200 days. Now, during a market correction, assume that you believe that the market is oversold and a rebound is imminent. Which stocks should you look at more closely? What about the stocks that have fallen the most during the crash? Sounds simple enough, right? So to test this, I downloaded historical prices for almost 3,000 US stocks going back 30 years. These are the stocks included in the S&P 500. Those are the large cap stocks, but also mid cap and small cap stocks. For each correction in the S&P 500, I will calculate the return during the market sell-off for each stock in my universe. Then I will create 4 equal weighted portfolio based on how bad or well the stocks performed during that period. And then I will look at how those 4 portfolios performed during the rebound. For example, the portfolio of the worst fallen stocks during the 2023 sell-off outperformed the least fallen portfolio by around 9%, 1 month after the sell-off ended. This assumes that we created the portfolio just before the rebound. The same holds for other corrections as well, with some few exceptions. On average, the worst fallen stock portfolio has 10% outperformance versus the least fallen portfolio measured 1 month after the market correction. And intuitively, this might make some sense, right? Because the more the stock has fallen, the more potential there is for catching up to its historical levels once the sentiment has changed. A more technical explanation for this is that if you somehow manage to time the rebound, you want to be exposed to stocks with a high beta. That is a sensitivity to changes in the market. If you want to know more about betas and have a tool that you can use to calculate your own beta exposure, I made a video about just that I will link in the description. So in the previous backtest, we assumed that we somehow had perfect timing. We were investing just as the rebound started. Let's assume instead that we are creating our 4 portfolio just after the S&P 500 is down 10%. How would our portfolios look like once the market rebounds? So to test this, we create 4 portfolios where each stock is ranked in terms of price returns when the S&P 500 was falling and hitting negative 10%. And here there's no outperformance to talk about when looking at returns 1 month after the end of the market correction. You're not better off investing in falling stocks that early in the correction. And the same holds for 3 months. Buying the stocks that have fallen the most when the S&P 500 is down 10% is in many cases like catching a falling knife. Now, what about if we invested right in the middle of the market correction? So that is the date just between the peak and the valley. And similar to before, there is no outperformance here since the timing is way off. So once you start to move away from the unrealistic assumption that you can do perfect market timing, the outperformance of investing in the most fallen stock tends to disappear. Just looking at falling stock prices in isolation doesn't really seem like a good idea. Now, if you're looking at individual stocks, the better approach is to find stocks that you have analyzed before and have a rough estimate for where its valuation lies, and then you will see in the market during the market correction to see if the pricing becomes more attractive. But in this video, we're just playing around with historical prices here. There's no fundamental data here. So now, a major issue with my analysis is that it suffers from so-called survivorship bias. I might look at plenty of stocks, but I'm only looking at the stocks that are listed today. So my analysis does not include stocks that have been delisted. If I'm looking at past returns, I'm not going to include stocks that were falling in price and never rebounded because of an eventual bankruptcy, for example. While delisting doesn't have to be negative for a stock price, for example, when a company is being acquired, the buyer usually bids up the price of the stock before it's being delisted. There are plenty of events that can cause delisting, not just bankruptcy, but there is a bias nonetheless in my backtest. I am planning on using data for delisted stocks to see how big this survivorship bias is in my analysis, but that's going to be a subject for a future video. So for now, please take my results with a grain of salt, because knowing that this bias exists. Now, instead of doing something as crazy as stock picking, what if you're using a more passive investment approach? Let's say you hold a broad mix of bond and stock ETFs. Should you just ignore the chaos completely? So for many, that's probably wise, but during a broad market sell-off, your asset allocation has probably shifted away from your target, whatever it is. Your allocation to bonds have most likely increased, because in a market stress scenario, investors tend to flock to more conservative assets, pushing up their price and selling riskier ones like stocks. Meaning your allocation might be too conservative for your liking. You have too much bonds in relation to stocks. So you could re-weight your portfolio to your target allocation. That would probably mean that you're selling bonds that have gone up in price and you would buy stocks that are now cheaper. Sounds good, right? But the issue is volatility, because during a market stress, volatility spikes up. If you're going to try to re-weight your portfolio again and again to reach your target, odds are that you're just going to accumulate the transaction costs. So instead, it might be better to reevaluate your asset split after volatility has come down to more normal levels. Or you stick to a fixed schedule to do so, for example, every quarter. Because having a more systemic approach removes some of the emotions in your decision making. That's it for this video. Thanks for watching. Don't forget to subscribe and like the video, and I'll see you in the next one.